Hey, we're back. Hello, it's Mitch Goldberg. You're watching my live stream all about personal finance, investing. We talk about it here. We want to make you the boss of your money because it's very easy for your money to become the boss of you. We lose control of money. We wonder, where has it all gone? How come nothing's left? I'm not saying this is all of you, and some of you don't need to worry about that. But the point is, we can all use a little more control over our money, right? And that's what the show is all about. So you need to understand what's happening with the economy, with the stock market, with your investments, but that's not all. I recently had a luncheon with some members of my networking group. We call these roundtable discussions, and every member has an area of expertise, and they have the other members come have lunch with them and give I don't want to say a lecture. They give a talk, very interactive, to teach the other members about their their strong suit, education. And my thing was recently that just because somebody is a client of a financial advisor like myself, or hopefully you have one who you really like and trust. If you don't, definitely reach out to me and we can talk about this. But it's not just because somebody's a client doesn't mean they're ready to be a client. There are other things that need to be done in terms of financial coaching, I think, before somebody's ready to be a client. And that might sound silly, but just think of it this way. I sometimes have new clients come in with a large chunk of assets right off the bat, often because of a rollover. They roll over their 401k to an IRA, and they could have a good amount, a good, healthy six-figure account. It doesn't last them because they often don't have the building blocks of personal finance in place before they had the money. So if you're not good with your money, with a little bit of money, it only becomes magnified when you have more money. You don't become better at personal finance because you have more money or because you made more money. You just see that your personal finance deficiencies become magnified when you have more money. That's why you see people with so much money, Michael Jackson, Mike Tyson, Nicolas Cage, and so many other people, Lady Gaga, who have hit it big, made fortunes, and yet wind up broke or bankrupt or just really, very little to show for it money wise. And that's because they didn't have good personal finance before. Personal finance is a whole big thing. It's not like a little thing that you kind of have that you figure out along the way. Yes, you do learn along the way. I'm a lifelong learner, so I'm not saying don't learn along the way, but you really have to make an effort to learn a lot in the beginning. I'm not saying lose all of your spontaneity. I'm not saying you can't splurge once in a while, but if I'm going to spend money in a day, I want to know what I'm going to spend. Okay, I come in tomorrow, Tuesday. Am I going to spend for lunch? Am I going to spend for a technology upgrade for my system that I use? What's it going to be? I want to know in advance. And if something does pop up, I'll consider it. Anyway, I like to put some distance between my thing that I want to spend money on and the actual time when I make the purchase. Because often what happens is when you put some distance, some time between what you want and what you're, and you actually swipe your credit card, you often change your mind and realize, I don't really need it. I don't really want it. Okay. Anyway, while you're watching this, hit me up with your questions. I love hearing from you. It's the best part of what I do. It's be the boss of your money. So money questions, financial questions, you name it, hit me up. If it's something very personal, then I definitely want you to reach out to me. You could DM me and we'll set up a time to speak. No problem. That is fine. In fact, I would love you to do that. And that's about it. So I'm going to roll the intro real quick and I'll have this here and we're going to get started. It's going to be a really good show. And I'm going to share with you the most important headline of literally, like, I don't want to say of the century, but definitely of this bear market. Here we go. All right, you're watching Be the Boss of Your Money. We're just getting started. It's a great day in the stock market. We've had a lot of really big up days in the stock market. They only get repealed. I've said before, I just want to say it again if you're new here. I don't like big up days in the stock market. The really big rallies, 500, 800, 1,000, 1,200 points, these giant up days, because they often get repealed. They kind of fade away over the next couple of days. They don't stick. I would rather the stock market build on smaller but solid, holdable, sustainable gains. That's how I like to see it. Obviously, the stock market doesn't throw us pitches that we like. The stock market is meant to throw us sliders, knuckleballs, curveballs, and every other kind of tough to hit pitch. By the way, Jolie, I see you. Thanks so much for the thumbs up. Maybe you and I should do a live stream together to talk about the jobs market, the labor market, because that's your business. That's what you do. So let's just jump right into it. What's the most important headline today? It was a big up day, but what really was like the spark? I'll show you here. I'll pop myself up here. This is it right here. Bank of America CEO Brian Moynihan says latest spending and savings data show that the U.S. consumer is healthy. I can't even like overstate how important this headline was. The market rallied starting with the futures this morning. Pre-market, before the market even opens, there's already stock trading. It's just pre-market trading. In any event, the Bank of America, in any event, the Bank of America numbers is what really sparked this rally. There were other good things happening today, but when one of the biggest banks in the country, I think Chase might be slightly bigger. I really don't know. Let's say they're comparable, but Bank of America CEO says the consumer is healthy. And who would know more than the CEO of one of the biggest banks in the country? Why is the consumer healthy? They could be a little weak in inflation, but he says the consumer is healthy. No doubt it's because of the strong labor market. No doubt another thing that's happening, a headline came across yesterday. I wish I pulled it up, but you'll have to just take my word for it. This is a headline yesterday. And this has been being spoken about for a week or so now. We spoke about it here. Port congestion is clearing up. Unlike my really bad sinus congestion, which is why you didn't see me last week. I was away for a few days and I came home sick. I'm going to have this nasty lingering cough for weeks. I can already tell. But anyway, port congestion. Do you think if I'm on a decongestant that I can't be a game show contestant? It rhymed. I'm just going with it. Yeah, a little goofy today. I'm a little tired, but port congestion clearing up. Goods are showing up. Goods are moving faster. Consumer demand is down a little bit. Goods are, supply chains are coming back. That's even with China's strict COVID shutdown policy. Stores are stocked. Shelves are stocked. You really can't say you can't find goods. Now, prices are higher than where they were before the pandemic started. I get you. But businesses, in particular, automobile companies and oil companies, I'll say energy companies, I'm going to include natural gas, are much more disciplined. And if they don't see prices high for energy, they're not going to want to drill. These companies typically are cyclical. They're boom and bust. They drill until everybody just throws up on all the extra gas and oil. They stop drilling, prices go up, and then they have to start drilling again like crazy to catch up. And then they're either spending a lot of money or they're losing a lot of money. It's just one or the other. So big sectors of the economy have much more financial discipline. This is what happened to the airlines. The airline industry was always too much capacity. You would only invest in an airline stock either as a trade or if you want to generate a tax loss. Now airline companies are sustainable, healthy companies. And let's say they've taken a page out of the tech companies who also had to go through their period of bust, their nuclear winter after the 2000 tech wreck. So this is a reason why the stock market is as bad as things are. And that, yes, I know the stock market's down a lot, but this is a reason why maybe we need to trust this rally. This is a reason why maybe we need to be a little bit more optimistic. I've talked about optimism and how important it is. Great things have been achieved by optimistic people, not pessimistic people. Prove me wrong. That is critical to what's going on now. There's optimism. And I think we could start being optimistic about the market, about the stock market, and even maybe not be so pessimistic and not even be so pessimistic about the economy. Now, all the time I see from companies like Apple, and I saw another one, a couple today. The point of the matter is I see a lot of stocks all day. Companies and Wall Street strategists, is what I want to say, Wall Street strategists from large firms have come out and said they see a recession early 2023, mid 2023, late 2023, maybe in 2024. Okay. Maybe they do. Maybe they're wrong. Maybe they're right. Doesn't matter. It really doesn't. And I'll tell you why it doesn't matter. Because, and this is key, there are a few things you can do to control what your outcomes, or at least do things you could control to make outcomes potentially more favorable to you in life. And other than that, you're just going to keep on investing. Please don't make investment decisions based on what you think the economy will or won't do. Are you somebody who is going to sell all of your stocks because your whole retirement account, everything you have, because you think a recession is coming? There's always somebody that says, "Oh, my uncle, my friend, they sold everything. They knew it was coming, and then they got in at the bottom." I would really like to see proof of that, because you always hear these stories about people doing that. I'd like to see proof, because up until now, and I've dealt with thousands of investors over 30 years of this business, I have yet to find the person who does that. People always bullshit me. They say, "I bought this here, I sold it there. I bought this here, I sold it there." And then when I see the statement, "You didn't tell me about this one that you bought up here and sold down there. You didn't tell me about this thing that you bought up here. It's almost worthless. You're still holding on to it, so you don't think you have to tell anybody about it." See, that's the difference between a financial advisor. Okay. I'm a financial advisor. My registered investment advisor is Next Financial Group. So as an advisory practice, I have to be straight up. That's what you'd expect, right? So I don't get to cherry pick my winners and tell you about my winners and kind of hide my losers. But I see it all the time. People love to tell me that. I saw somebody recently. She's like, "Oh, I bought this, I sold that." This person doesn't remember telling me that she bought Teva Pharmaceutical years ago at much higher prices. And I always ask when I can remember. I do remember. I have a really good memory. Okay, so anyway, I digress. We may or may not have a recession, and so what? Over the next 20 years, 30 years, we're going to have a whole bunch more recessions and bear markets. And then we're going to have bull markets, okay, and economic recoveries and economic expansions. Recessions are different than they used to be. I hate saying that it's different this time, but they are different. Recessions don't affect the entire economy the way they did in the 60s, 70s, and 80s. Okay. Um, I was born in 1967, so I have the vaguest memories of my childhood of sitting in the back seat of my father's big car with my brother, because you had to wait online for hours for gas, and we had to go with him. It was so boring. Oh my God. I still remember the boredom. My brother and I would just fight in the back seat. My father would scream and yell at us to finally get gas. Poor guy. We must have exhausted him. My kids do it to me now. Anyway, but I do have the 80s and 90s, and now I've been in the industry for just about 33 years now. Recessions are different because they don't affect everybody the same way. at every step of the way. I said to a client this morning, and she lost her job, and she has a pretty significant amount of assets, so it's okay. She'll be fine. She lost her job, and I said, for you, it's a recession. You lost your job. But there are people who are doing great in their job and have a lot of job security. And they're thinking, what recession? Everything's great. So just because you're in a recession and the overall economy might be in a recession, let's say 51% of the people could be in a recession, 49% could be in an economic expansion, which is the opposite of a recession. So it's not, we don't all go in the hole and out of the hole together. And even during boom times in the economy, even during boom times in the economy, there were always sectors and groups of people and individuals who were doing poorly. So recessions, economic cycles, while they still go on and on, of course, I think the U.S. economy has become so diversified, since 1980, continued through the 90s, and it just accelerated up until now, that it doesn't affect us because software is not food, is not healthcare, is not manufacturing, is not discretionary, is not consumer staples. We're just a very diversified economy. So we're not going to all feel economic pain at the same time and in the same way. So that's my story with that. And I hope you take that seriously, because it has ramifications for you. So what do you do in a recession? How do you protect yourself? Because I was talking with actually I was emailing with a reporter today at Newsday, a very fine gentleman. I'll just use his first name, Ken, and we have a very nice rapport. We talk often about the economy and the stock market. We even joke around it. We talk about other things where we've become, friends, okay? Networking friends, maybe, if you will. Anyway, nice relationship. And excuse me. What I said to is, people are focusing the wrong thing. They're focusing just on the recession or just on their investments. And I said, you really can't do anything whether or not we go into a recession or if we go into a bear market. Here's what you could do, though. You could let your personal finance guide you. So should you be out of the market? And I get this question all the time. Should you sell? Should I sell everything? Should I go into cash? I recently met someone. She's just turned 40 and she's worried about the market. Her 75-year-old dad said she should get out of the market. Let me tell you what's wrong with this. Okay, there's two things. First of all, she's 40. So whenever somebody asks me a question, should I be in the market? Should I be out of the market? Should I invest in this? Should I buy that? Sell this? Sell that? I always answer it the same way. It depends. Let me ask you a question. And then I start with some questions and you glean the information you need to give a reasonable response. The response was, this person's worried about a 401k. When are you going to need that money? Oh, I'm 40. I'm not touching that for at least 20 years. So why would you sell now? 20 years. Your time horizon is so long right now. Well, my dad says I should sell. Your dad's 75. His perspective is dramatically different. His time horizon is basically here. Now, we could debate whether a 75-year-old person should be in stocks or not, or somewhat in stocks, or a little bit in stocks, medium in stocks. That's a matter of personal finance for that individual. I'm not giving you a hard and fast rule. Oh, you're 75, you should be 25% in stocks and 75% in bonds. I don't like, these rules of thumb work just enough to screw you at the worst possible time. There used to be a rule like you take 100, deduct your age from that. So if you're 100, you take 100 minus your age of 75. If you're 75, that means 25% in stock. So if you're 90, 10% in stock. The rest would be, let's say, cash and fixed income. They might be a good place to start a conversation, but it's not a place to end up with a solid, concrete, workable portfolio. So that's one thing. The other thing is to focus on, if you're worried about a recession and you're worried about your job, your most valuable asset, which is your ability to earn an income, that's your most valuable financial asset, isn't it? To earn your income. I know people say my house, my account. different stages of life, certainly. Okay. If you have a high net worth, maybe your income isn't as important. But for most of us, our income at some point in our life was the most important thing we had in our life to help us get to where we want to go, or in some cases to where we are. And I hope that's in a good place. But if you're worried about your income, instead of putting so much time into worrying about the stock market and the economy, which you can't control, focus your time on something you can control. Earn a new certificate in your field. I have a couple of certificates in my field. Okay, I'm an accredited investment fiduciary. I'm an accredited asset management specialist. I have these designations to prove my value, to show clients and employers that I'm valuable, that I am always looking to learn the latest and greatest in my industry, that I'm keeping up with the times. You need to do that if you're worried about your income, if you're worried about your job. You need to, instead of worrying about your job, worry about making yourself more valuable in the workforce. That is a very worthwhile investment. Invest in you. YOU. Invest in you. Okay. All right. So let's take a look at the boards here. Okay. We're going to go over here. So the Dow up 550 points. Good day. Nice rebound. Nasdaq up a lot, up almost 3.5%. I like to say 1% up or down in the averages gets my attention, but a 3.4% really gets my attention. And you have my attention, Mr. Nasdaq. What are you going to do next? Stocks like Zoom, tech stocks, just things worked out today. And it wasn't just the most aggressive stocks that get hit the hardest that worked out today. Bank stocks, industrials, consumer discretionary, lots of things, lots and lots of different sectors and stocks worked out very well today. S&P was up 2.65%. Gold still in the 1600s. You know, if people are thinking that inflation is going to peak or it's at its peak and it's going to start to roll over, you could point to gold as your corroboration. Gold isn't moving up, it's moving down. Gold goes up during times of inflation. So does crypto, by the way, because, when there's too much inflation, too many dollars printed, it means inflation. It's, you print more dollars, they're worth less. So it takes more dollars since they're worth less to buy your everyday goods and services. Anyway, oil stuck in the mid 80s. Okay, look better. If you recall not too long ago when oil was $120, $129 a barrel, all of a sudden people came out of the woodwork, or I should say, people came out of the oil well. People came out of the woodwork and they were saying oil is going to 150. The next guy on CNBC says oil is going to 175. The next guy says oil is going to 200. The next guy says it's going to 300. Everyone has to one up themselves to get attention. And here we are, oil at 85. There's plenty of oil that's coming out of the ground. It's not all political forces that are guiding the price of oil. Companies can drill. Like I said, oil companies have financial discipline that they didn't have 10, 20, 30 years ago. And they have better technology. Plus, we have Saudis et al. Who F with us all the time, which is a good reason to be independent of energy. We have our own energy independence. And I do think that also adds to the desire to be sustainable clean energy, because clean energy in this country is really about, like plugging cars, it's about natural gas, because most of our power comes from nat gas, not from oil. Surface fuel is oil, okay? But, okay, you get my drift, okay? 10-year yield a little bit above 4%, unchanged, barely up. But, we've got a 10-year that's starting to be sticky at 4%. Not hit 4% and back down to 3.5%. It's getting sticky at 4%. I'm not surprised. It doesn't mean that inflation has to go dramatically higher in 6 months to a year. It just means it's about time that the 10-year yield finally is catching up to the 2-year yield, which has been at 4% now for a couple of weeks. The VIX 31 does not indicate too much fear in the market right now. Okay, let's take a look at the bond market. the more important chart lately. But here we go, the 2-year at 4.45%. But basically, from 6 months all the way up to 30 years now, the whole yield curve is basically above 4%. So it's a new yield curve. It was an inverted yield curve like that. Now it's just an inverted yield curve like that. The whole thing has been raised. But with the 10-year, the 2-year at 4.45 and the 10-year at 4.01, the 2-year still remains a good deal, 40 bips, 40 basis points higher than the 10-year. But, 40 basis points is not as much percentage wise today with higher yields as it was a couple of months ago. In any event, that's where we stand. We still have an inverted yield curve, which still indicates either we're in a recession or recession coming. But again, the recession today might require a different or more varied definition. Okay. Let's see the watch list. Let's take it. Okay. Consumer discretionary stocks up over 4%. That is indicative of a strong consumer. What's consumer discretionary? Okay. Let's talk about the brands. Nike is consumer discretionary. Well, Ferrari is the ultimate sign of discretionary, right? So, discretionary stocks did well today. I didn't look at the price of Ferrari. I'm just saying, giving you an example of discretionary stocks. The symbol for Ferrari is RACE, RACE, if you'd like to go look it up yourself. It's not something I'm recommending. I'm just saying it's a discretionary stock. Tiffany Jewelers, high-end department stores. These are discretionary, okay? Harley Davidson is discretionary. Although some of you don't think it's discretionary. As they say, motorcycle enthusiasts will say it's not hoarding if it's motorcycles. Okay. And another friend of mine will say it's not hoarding if it's guitars. Right. Bobby Bird is watching. Thank you, Bobby. I really appreciate watching. My partner in crime. My partner. I shouldn't say my partner in crime. It's goofy. Partner. Okay. If you have any questions, folks, hit me up. So that's really about it for the day. We're just about up to our time. I thank you so much for watching. If you'd like, if you have more questions, you want more information about Client First Strategy, about myself, about what we do here, certainly reach out to me. I'd love to have a conversation with you. I'm going to sign off, and I look forward to seeing you right here tomorrow.